Hello, everyone. Thank you for joining us today. The webinar will begin shortly.
We don't have the first slide.
Hello, everyone, again. The webinar will begin shortly.
Hello, everyone. I'm Bill Hoover, Vice Chair of SCORE Chicago, and I'm very glad that you could be with us today. We're going to get started in just a few moments. We have a really great program for you today from London de la Palo on accounting, and we hope that you are prepared to listen to some numbers and the strategies involved. So we'll get underway in just a few moments. Thank you. Well, we're going to get started now, and I ask that all of our participants and viewers get your pencil and paper out, your computers, your laptops, and be prepared to take notes for our special program that we have today on uncommon tax strategies and business. I'm Bill Hoover, Vice Chair of SCORE Chicago. We've been around since 1964, providing services to clients in all areas of business, industries, and markets, both locally and nationally. And as SCORE, we've had the opportunity to not only work with many businesses within the nation, but also within our communities. When I say nation, that's because we're a big organization. We have 354 chapters throughout the United States with 10,000 members. And we're here in Chicago with the SCORE Chicago. And this whole program is brought to you by the Chicago or SCORE Chicago Black American Council. What we're looking to do is have a deeper dive into the relationships that are fostered in communities to develop businesses, look at the nuances of what business really is, and start focusing on various areas that may be of interest. So we always ask that you participate with us by asking questions, making suggestions, and just being a part of the entire process, because we're here to help you. We would like you to participate with us in more ways than just coming to or visiting our webinars. We'd like for you to come in and talk to us as well. London Tiller, who is the CEO of his organization and who will be giving the presentation today, is also one of our mentors. So we're looking that you get a lot of information from him going forward. So again, my name is Bill Hoover, and I'm Vice Chair of SCORE Chicago. I'd like to introduce our speaker that's coming up, and that's London Tiller Paulo, who is a Pan-African global citizen and African market strategic and investment consultant. He obtained his MBA from Eastern Illinois University and a bachelor's in accounting from Michigan State University. Paulo has worked with entrepreneurs and investors across Africa, identifying markets and evaluating businesses and investment opportunities. Currently, he is an audit and assurance associate with Cone Resnick, LLP, an investment officer with Ashante Investment Group, an entrepreneur and investor in places in Nigeria, Angola, Ghana. His interest is to give back to the community. He has joined SCORE to help small business owners become new founders and achieve a business goal. And I've always indicated that accountants are your best friends. They can give you a headache, but they're your best friends because they understand the dynamics of the business. Your job is to understand what it is that you're looking for in that business and where you want the business to go. So I'm going to turn that over to London Tiller. Thank you so much.
Awesome. Thank you so much, Bill, for that introduction. I always love and admire your energy, and you've been a great mentor to me and to other uh, business owners in Chicago and across the nation as well. And thank you for your leadership at the Black Americans Council. And today in this webinar, I want to start by thanking all of our participants and listeners who are joining the conversation today. And the promise we will make to you is that the next 1 hour or so will be worth every single second you'll be spending with us. And my goal with our webinar today is to give you some strategies that you can implement starting right after the end of this conversation. So often a lot of people look at taxes and either they avoid it or they hate it. But through this webinar, I will show you that it's possible to actually enjoy taxes and use it to help you and your family build your financial life if you do it correctly. And I just want to go ahead and talk to us a little bit about how we're gonna move through this presentation. So I will start a little bit to point out some of the major issues around the U.S. right now in terms of finance and retirement and savings. And then I will point out to all of us some of the reason why a number of these issues are so pervasive to our society. And I will tie together how tax strategy can actually help you to take advantage of the existing loopholes in the tax code. And that's part of the reason I put there. It's a commonly missed deduction. So we're gonna look into those and walk you through a demonstration, an example with numbers so that you actually see how these tax deduction can and may help you if you take advantage of them. And we will conclude with some best practices and some Q&As if we have a question at the end. So often when I talk to my clients, whether it's through Score or through my business, I always want to put this idea you're seeing in this screen right now in their mind. You have to run your business as if you were a public company, or at least as if one day you would sell your business. By putting it by encouraging them to think about their business this way, the message really is you have to get organized as a gig worker or as a small business owner or a self-employed or freelancer, whatever category you are. So I also want to share this message of encouragement to you as we are starting this conversation. Start thinking about your business as if you were a public company. And if you know a little bit about public companies, you will understand that public companies, every single one of them, have very strong systems and processes in place. They have very strong accountability system. They have to report on a monthly, some of them monthly, most of them on a quarterly and annually. They have deadline goals that they are striving to achieve. If they don't meet, for example, the earnings projections, the market punish them, their stock goes down. And when you start thinking about your business that way, it will do a lot of good for yourself. So let's talk a little bit about who this webinar would help the most. If you are just a W2 person, unfortunately, the strategies that I'll be sharing today may not apply to you, but one or two may be used for your case. But this webinar is designed especially to help small business owners, self-employed individuals, freelancers, or gig workers. And the way you know you are a gig worker or freelancer is if you receive the form 1099. Now it used to be 1099 miscellaneous, but now it's 1099 NEC or non-employee compensation. And through this webinar, again, I want to reiterate that my primary goal is to help you learn about strategy, or if you knew them but you aren't used them, to encourage you to use them with the primary goal to reduce your taxes. I work with clients that in prior year before they engaged me, they were paying substantial amount of taxes. And most of these people, we've helped them cut their tax bill at least by 30%. And some people were making really drastic mistakes where they were overpaying, as I will show in a few minutes, that the majority of people in the US actually overpay their taxes. And especially small business owners, they are even in a worse position. Uh, and the last goal of this webinar will be to give you best practices to avoid the IRS audit, which is very often a very scary place for a lot of families and small business owners. So what is actually taking place today in the US? What we're seeing in the US today is these three major challenges in terms of personal or family finance to retirement and taxes. The first area we're seeing the challenges is at least 95% of small business owners are overpaying their taxes. You can find this report from Business Insider, or if you run a quick Google search, you'll find the news, the blog article that I found this data on. And the second piece of challenge that is a little bit more concerning to many Americans today is the fact that billionaires and multimillionaires are paying less and less taxes compared to the average Americans or the average individual living in the US today. And often from the news, when we hear about multinational companies or Fortune 500 companies are paying less taxes or almost zero taxes, there is an outrage, there is anger, there is a lot of criticism towards this company. I am not here to condemn or favor them, but I'm telling you that they are simply using the tax code in a way that most of us are not using. And because of that, they are paying less taxes by following whatever it's written in the tax code. And just a side way to that is to remind us that the reason the government writes the tax code, whether it's a local, state, or federal government, uh, creates tax incentive is to help individuals and people pay less on taxes so that they can invest in the economy, so that they can support the economy. For example, the government wants the country to have more affordable houses. That's why there is a lot of tax credits, a lot of incentive in investing in real estate. The government wants the more job creation. When you start a business, you hire employees, and if you pay them health care or other benefits, there is a lot of credits, but we don't have time to go through all these now. But the bottom line is, whether people consider it fair or unfair is actually a little bit more challenging than that. And the third piece of challenge we have today in the US is that at least 50% of adults over 50 or nearing retirement age cannot afford to retire. They don't have enough saved for the retirement here. And all these pieces of data combine brings us to the question in terms of, given the challenges in terms of saving, taxes, and retirement, what tax planning can help you to maybe just avoid some of the challenges that most people have today? Can tax planning help you reduce your tax burden? Can tax planning help you add more money towards your retirement? And the answer is yes, it can. But let's see why that is not happening today. The main reason a lot of people are overpaying taxes is especially because people are not taking advantage of the tax code. And a lot of people, as we're gonna see in the next slide, they are missing substantial amount of deductions, tax credits and benefits and exemptions because they are not using a tax professional. They are relying on software just to enter the information, or they don't have good bookkeeping in place, or they simply see a tax preparer at the end of the year, and by then it's too late to absolutely do anything to help them. If even in case a tax preparer know what they're doing, they can't really do much other than put additional money towards your retirement, or if you have a health savings account and it hasn't been maximized yet, you can add a little bit of money there that could reduce your tax burden. But at the end of the day, it's important to remember that tax planning cannot be done during the tax season. It has to be done throughout the year. You have to find ways to consistently meet with your tax advisor or tax planner or tax professional, accountant, whoever that person is, especially if you're a business owner. Now let's go back to look into some of the commonly missed deductions. I was purposeful in choosing these 6 deductions because they are part of all of our lives. Every single one of us spend money in these 6 areas of our lives. And for the people who don't have a business, I always tell my clients, you have to have a business. It doesn't mean you have to leave your 9 to 5 job or 8 to 6, whatever your schedule is. You don't have to leave your corporate job, but you absolutely, if you want to take advantage of the tax code, if you want to reduce your tax burden, you have to have a small business or start a side gig or invest in real estate or do a combination of the above. But here's the foundation. I will walk us through a demonstration to show you that if you only have a W-2 job, your tax savings are substantially slim compared to if you had started a business or a side gig, or you do you do some freelancing work. So we'll look into retirement contribution, healthcare, traveling, meals, auto, and home office. And just by the way, a W-2 person can deduct some of their income and contribute them to retirement and makes it not taxable. For healthcare, it's a little bit tricky there. For home office, traveling, auto, and meals, a W-2 person cannot deduct these in their taxes. But if you are a self-employed person or if you own a small business, all these can be deductible. And we can see the power of these through this quick demo. I'll stop sharing this screen and share a different screen in a second. So just bear with me in a second, and I will share a different screen to walk you through a different scenario, okay? Okay, a little bit of silence there, but we are gonna get it done soon. Give me just 1 second. Okay, and please let me know if you can see the spreadsheet that I have in front of us. Give me a signal.
Yes, we see it.
Okay, awesome. So we're gonna go through these 6 different, excuse me, strategy to show you in real life how you may or may not be taking advantage of some of these deductions. And I will show you the long-term implication of not taking advantage of tax planning. Okay? So let's start with home office. What is a home office deduction? Home office deduction is the type of deduction you can claim, or as other people say, a write-off that you can claim by meeting the 2 criteria above. And the criteria are the following. You are a small business or a side gig worker or a freelancer that has reserved a space in your house that is exclusively and regularly used for your business. So one of the thing a lot of entrepreneurs that I often come across and I talk to struggle to understand is that even when you are a sole proprietorship, you are effectively a business. Even when you are a Uber driver or a Lyft driver, you are a business. The IRS considers you a business. But because of that, a lot of these wonderful people don't take advantage of this deduction simply because they do not understand that all these things are available to them. So the first thing to qualify for this deduction, you have to have a space. In my house, back there, I have a space, a mini office where I conduct my work, a space that is exclusively and I use it regularly for my business. I have a desk, two monitors, some filing cabinets. It's specifically for my business. And then the second similarly important idea is it have to be your primary place of business. A primary place of business means you conduct administrative work in that space. So do you reach out to client? Do you do the client's work there? Do you email people, make phone calls? Do you generate income from that place? And for most people, it's really easy to qualify for these two rules. So, one, you create a space in your house, and two, you use that space exclusively for your business. So, to claim the deduction under this method, you have two approaches. Number one is the simplified, where the IRS allows you to take $5 off up to 300 square footage that you use for your business. So, for example, if you have a 1,000 square footage home and you use 300 square footage of this business, excuse me, if you use 300 square footage for your business, your deduction under this simplified method is 1,500. You don't have to keep a lot of documentation for this. It's simple, straightforward. But if you want to maximize your deduction, I often encourage my client to use the regular method, although it's a little bit involved, but it provides substantial deduction. So let's assume you pay 1,300 a month for rent and you pay about let's just do an average. All of your utilities per month comes down to $250, and you're paying a renter's insurance of $20. There is no repairs because your landlord pays for all of those, and other expense in your house that you use for the common space comes around $50. And you lease for in that place for 12 months. So the annual amount you spend for the house is about 16,000. Now, your house is 1,000 square footage and you're using 300. So based on this approach, you can actually claim about $4,845. Wouldn't that make a difference in your tax return? If you're a W-2 person, you can't claim anything. You have absolutely zero to claim. But if you had a business and you reserved this space, you could claim whatever portion of your business use of your houses as the total of your expense, your home office expense. Now, for LLCs and sole proprietorship, this is very simple and straightforward to do. But if you are an S corporation or a C corporation, it's a little bit tricky because as an S corporation or C corporation, you are an employee in your own business. So you can't really write home office deduction in your tax return or in the business return. Rather, you have to reimburse yourself tax-free money. So these $4,845, you would reimburse it yourself and your corporation will claim it as a deduction. So office or rent expense. So that's our number one deduction. The number two deduction is the healthcare. All of us have to spend money for healthcare, right? So whether it's through health insurance or through any other out of the pocket expenses. So the challenge here is if you are a W-2 person, you only are allowed to claim healthcare expenses through your Schedule A on your Form 1040. And in the Schedule A, you are allowed to only claim any amount over 7.5% of your adjusted gross income. So for example, if your adjusted gross income was 60,000 a year and your medical expense were 3,000 out of the pocket, you don't have any deduction because 3,000 is below 4,500. So effectively, you have zero deductions allowed. But if you were a small business owner or a gig worker who actually understand the tax code, all of your $3,000 of medical expenses, including any amount you spent in health insurance, are completely deductible, 100%. So let's see how that could have turned out if you had adopted, for example, a health savings account. So a health savings account, just a quick run through this, is basically like an RRA account. You put any money into this account to pay for health or medical expenses. And that money, the good thing is it can be rolled from year to year. You don't have to use all of it. There are certain limitations in this account, but one of the limitation is you have to use a high deductible health coverage plan. So if you are healthy, for example, I use the health savings accounts because, as I will show you in a few minutes, I can put aside some money into this health savings account, and it allows me to reduce my taxes really easily, and this money can grow tax free, and I can draw money anytime to pay for health, for my health needs. And the high deductible plan, any amount that I have to pay for health care needs, I can take them out of this health savings account. So it's easy, pretty straightforward to use. You can open one of these accounts with any bank or a credit union, or any brokerage firm. So it's pretty straightforward. A health reimbursement account doesn't actually require you to have, per se, a health insurance. You can create a health reimbursement arrangement in your business where you reimburse yourself any medical expense, right? So, for example, but there are several processes and procedures you have to have in place: a written plan, a non-discriminatory plan. If you're a self-employed, you own your own business, a health reimbursement account can do wonders for your family and your business, especially if you are married. You can hire your spouse as an employee of your business and reimburse them any expense your spouse and the entire family incur. So let me just show you one of the example, in an hypothetical scenario that we actually used with one of my clients. So we help them set up a health savings account where our target per year is to contribute $2,000, and they have a written plan we help them create where they can reimburse to themselves any medical expense they incur throughout the year. So let's just say for the year they plan to incur about $5,000 that they plan to reimburse themselves, and the total health insurance for the entire year is about $7,000. All that amount is completely an absolute write-off on your tax returns. You can write off $14,000. So a lot of people miss out in these deductions simply because they think I can save $200 by filing my taxes on TurboTax and I'll be fine. No, you're not gonna be fine. You're cheating yourself. You're eating on your savings. You're saving a few $100s, but you are losing thousands of dollars or potential thousands of dollars. So these are just the two strategies that I shared with you so far, and you can see the difference in the deductions available to you. The third strategy is retirement. Eventually, all of us will retire. For most Americans, for the average American, these two retirement plan are the most tradition the most available to them. They are either using an IRA or a 401k, and the maximum contribution for these are 6,000, excuse me, 6,000 to 7,000 if you're single, or 12,000 to 14,000 if you're married filing jointly. However, as a business owner, as a small business owner, as a self-employed individual or a gig worker, you can create what I recommend to my clients. Either create a SEP IRA or a solo 401k if you are the sole employee and owner in your business. So with these, you can actually contribute substantially more towards your retirement. Let's say you had an amazing year, right? If you had great sales and your revenues and income jumped to the roof, and you are seeing, wow, I can only maximize up to 6,000 in my account. Yeah, that may help you somehow a little bit, but think about the possibility of contributing, let's say, 20,000 to your retirement in a year that was super good for you. How is that going to reduce your taxes compared to 6,000? You have a potential 14,000 more to save. So these are the type of strategy that I'm saying it's not only for the sake of saving taxes, but are the type of strategy that are going to put your retirement savings that are going to impact and make a difference towards your retirement saving. So let's move a little bit quick here. So meals we eat all most of the time. As a W2 person, you can deduct any meals expense. As a self-employed person, especially for the people in the geek economy, you're an Uber driver, Lyft driver, or you use a platform, Etsy, whatever it's out there. Take the deductions. They are there to help your business succeed. I had a client recently for a consultancy who were paying taxes on their revenue, not net income. They didn't take any expenses they incurred for the business. They were paying taxes on their income. This is to say, if you don't know what you don't know, you are not going to be helping yourself, your family, or your business. And I really hope what I'm sharing with you today, you're taking some notes. And if you already have a tax professional, tax advisor, you take it to them to help you set up these structures in place. Okay. So back to the meals deduction. A W2 person can claim any meals deduction, but a self-employed, small business, gig worker can claim the deduction. So here's the great part. For the year 2020, 2021, and 2022, you can claim 100% of your meal expense. And by meal expense, I mean the amount you paid on food, the tips you pay, and the delivery fee if you do a delivery from a restaurant. This year has been much more exciting for me. In the past, you could only claim about 50% of the meal expense. So if you are planning, for example, for the whole year, projecting to spend about $6,000 for the meal, for eating out, that's awesome. That's a potential 6,000 you can deduct for your business. Now it's important for you to keep good documentation to show that this meal was for the business purpose. I met with XYZ. We talked about this, about the business, or I met with clients, with potential partners, with potential investors, and so forth. Because this is one of the areas that is really susceptible to audits. Okay, so the auto tends to be more complex, so I'm really just going to go really fast. We wouldn't have enough time, but here's what I want you to remember about auto expense. Depending on whether you want to buy a new car or lease a car or buy a used car, between now to 2025, there is what is called the bonus depreciation, which effectively allows you to write off 100% of the cost of the car. Like, COVID have been a hard year. 2020 was a hard year for a lot of us. Many of my clients can't really start making any purchase yet, but this is what I've been encouraging them to do. If you're planning to buy any car, if you're planning to buy any vehicle, or even a motorcycle or a boat for that matter, right? The bonus depreciation is available, and the section 179 depreciation is available, which effectively can allow you to write off up to 100% of the vehicle expenses. But that's not all about vehicle deduction. You can also claim all of the other expenses of keeping the car, right? If you choose the actual approach. So for consultancy with clients, we look into these two approaches. Which one would allow them the greatest deduction, right? The mileage approach, you write off whatever the mileage, the business mileage per year times the allowed mileage for the business, right? For 2021, it's going to be 57 cents, and we multiply that, that's the deduction. So let's say you're planning to buy a new car, and it's gonna cost about $20,000. If you use the bonus depreciation, you can effectively write off the entire cost of the car because it's below 25,000. And on top of that, you can write off fuel, repair and maintenance, insurance, tires, any interest you pay on the car, and so forth. So as a W-2 employee, you can claim this deduction unless your company reimburses you for any mileage you use for your car. Okay. Traveling deductions. A lot of people will be traveling after the pandemic. If you are a business owner, self-employed individual, you planned ahead of the time to meet with clients. So these are really important. You gotta have a business purpose for your trip before it qualify for deductions, right? Whether it's the airfare, the car rental, the hotels, if you paid Uber, or the parking, the valet, the toll, food, dry cleaning, all of these are deductible to you if you plan the trip to fit what the IRS considers to be an allowable deductible trip. So some of these items can be if you're traveling to meet a client or meet a vendor, or you're traveling to attend a conference, or you are traveling where you have a rental property, or you plan to travel with your board of advisor. So here's a cool strategy for married people. You can have your spouse to be a board advisor or board of or director in your business. That way, when you and her or you and your spouse take the trip with your family, you can write the entire trip off. You take some days to do the business affairs, and you only have to work 4 hours a day for that entire day to qualify as a business day when you're traveling. So all this information is available to you, and it's exciting. It's for you to use and take advantage. So let's say you're traveling and you meet a number of these checkbox here that I have, and you spent $1,000 to fly to your destination. You rented a car. Throughout the time you will be there, you paid about 500 for the hotel, and you didn't use Uber. You paid for the parking and the meals, and you use dry cleaning in the area. So potentially you could be deducting about 2,500. But if you didn't plan correctly for your business, right, if you didn't plan the trip accordingly, you wouldn't be able to take advantage of this amazing tax strategy. So we went through 6 different strategy: home office deduction, healthcare deduction, retirement contributions, meals, auto, and traveling deductions. So I want to show you how all these impact your tax return. Under a W-2, your potential saving is substantially small. If you have poor tax planning, you probably could get some of the deductions, some of the items you kind of know. But if you did a great job with tax planning, your potential deductions are close to 71,000. If your tax rate is 24%, you would be saving, by implementing all of these strategies that I shared with you, about 16,000 in taxes. So let's put that into perspective. If you are saving 16,000 a year just by using a good tax planning, and you put that into some form of investment account, and it's earning 5% per year, in 20 years, you will have accumulated more than 500,000. And the retirement plan, the retirement savings you have under the same condition would be, after 20 years, more than 600,000. And your health savings account, again, this is why I said these tax strategies are so powerful, because they can change drastically your life. The health savings account, if you're saving $2,000 per year, in 20 years, your health savings account will be $66,000 that you can use for your medical expense. And all these combined gives you about $1.2 million in your entire net worth. So this is where I said, I'm going to stop sharing the screen and to say, this is where tax saving is so powerful, because the moment you realize that you can use your taxes literally to create additional money out of thin air, this can change your life, right? As I showed you, the tax strategy that these are only 6 tax strategies that I use with my clients. But there are many other tax strategies that can be used as well. And when you put all these things together, when you put them in a very well built and implemented strategy, that's where you get the results, such as people paying literally $0 in taxes. This is the reason, this is not a political conversation, but if you look into Joe Biden's tax return when he was running for president, he paid millions in taxes, and Donald Trump paid virtually $0 in taxes. Not because he was cheating, they both were following the tax law, but they used different tax strategy. Donald Trump's tax strategy involved a lot of investment in real estate. And unless you are really a genius to generate profit on paper, real estate on paper usually provides losses. And when you have loss, you don't pay taxes. That's as simple as it can go. So as we're getting to the end of our webinar today, because I want to leave some time for questions, I just want to share two last strategies, because if I didn't share these with you, I don't think I would have done a good job, because SCORE is an organization that primarily helps small businesses and startups. And I want to share with you about startup deduction. Startup deduction allows you to deduct up to 5,000 to five up to $5,000 per year in towards your startup expense. So here's what a startup is according to the tax law. It's that period of your business, not really your business, that period when you decide to start your business until you get the first client. Okay? Until you get your first client, you are in the startup stage, and any expense you incur to file your business, to study the market, to hire accountants, lawyers, to do to set up your business up and running, those are startup expense. If you spend more than 5,000 per year, 5,000 during this period, the remaining balance will be spread throughout 180 months, where you will recover that amount and deduct them in your tax return. Okay. So I always encourage people to try to keep their expense below 5,000. And I know it's doable unless you're starting a hedge fund, which is a different story. But for most startup, for common people like us, I believe it's doable to do your startup development below $5,000. So the last strategy is real estate strategy, and I want to show you how real estate can be used as a potential tax strategy to reduce significantly your taxes. Please let me know if you can see my screen.
Yes, we see your screen.
Okay, awesome. So when it comes to the real estate space, I created these fictitious numbers. It's not an information about any of my clients, but just to give you an idea of what real estate can do for your business, your family, and your finances. Let's say you found a property that needs a little bit of work and you bought it for 150K in a distant area, and it has 2 units, and you put another 100,000 there, a total of 250. After that, you of course you made some down payment and you got a mortgage at 3% for 30 years, and you're paying an annual payment of 11,000, and you put it into rental, and this is how much you are receiving per year. But accountants are very conservative, so I made an assumption of 10% vacancy. So you have your rental income 27,000, operating expense 30,000, 30%, and you have your NOI, net operating income, before you start paying the debt. So you pay the debt 11,000 ish and you have a cash flow. So here's where real estate is fantastic. You won't be taxed in this $6,520 because you have to accrue the depreciation for the property. And this is one thing a lot of small businesses that I see often miss, calculating appropriate depreciation. And you see the depreciation is larger than the net cash flow, you're generating losses. You get $6,500, but you pay zero taxes on it. Now imagine replicating this every year. In 10 years, you have 10 properties generating this loss times 10. How would that impact your tax planning? And how much, if you are using this money to acquire new properties or putting it toward your retirement? This is this is what I say when I mentioned at the beginning of this webinar that the two major problems a lot of people have today in terms of overpaying taxes and having underfunded retirement can be solved through retirement planning. Excuse me, through tax planning. And the last piece in real estate benefits is real estate is great not only because it gives you tax benefits, it shelters a lot of your income, but the tax gain, if you bought the real estate and you put some work on it and total came down to 250 and you sold it 20 years later or 10 years later for 500,000, the tax gain may not be taxed if you follow another really interesting tax strategy that is section 1031, excuse me, which basically in a quick note is basically whatever you sold the property, you reinvest it in another similar property. Basically that reinvestment process allows you to defer paying taxes for the rest of your life if you repeat the process. But the way that I see some of the private equity firm that I did auditing on take money out of their real estate is to refinance the real estate and then they get the money out. So that's how they build their portfolios. So I really just wanted to share these strategies with you because I believe they work for common and average people like you and I hope this was helpful to you as much as it's always been for my clients, and I use these strategies for myself as well. Um, the last tips in terms of avoiding the RS audits is you have to to have good records. You have to have a bookkeeping system, right? If you don't have a good bookkeeper, you're doing a disservice to yourself. Don't just rely on TurboTax or Tax Act. These systems are great. They make our life really easy, but they're not gonna do tax planning for you. They're not going to tell you what you need to put in place a health retirement arrangement plan. They're not going to do all of these advanced level processes and put them in place for you. Even when you're filing your taxes through TurboTax and call a professional to help you with a situation you got stuck in, it's already too late to implement any tax saving strategy to help you. So throughout the year, find a professional that can help you with your tax situation. Find a bookkeeper. Ideally, you want your tax professional and bookkeeper to be the same organization, because when they're doing your bookkeeping, they already can start spotting and identifying some of the areas that can benefit some tax planning, some tax deduction. And of course, again, keep records, document everything. Like when I say everything, literally everything. Don't leave anything for to chance. In when I meet with clients, I tell them, hey, create two sets of filing system, a cloud and a physical. And anything that goes to the cloud have to go to your physical storage. Create binders, folders, write labels on them, organize them, and make sure they match the same thing you have in your virtual folder. So as we conclude, I want to take a time to thank all of you for attending the webinar today. That's my information with my business. And if you are a new startup and you'd like to get some information or need any help with SCORE, I am a SCORE mentor and I'm also available to help. Or if my expertise can't really help you, we have amazing people in SCORE and in the Black American Council. There are amazing mentors that can help you and your business go forward. The I participated, I joined the trainings and webinars of other mentors yesterday and the day before. They, there were some amazing content, right? And just to show you that the people in our chapter can help you get where your business needs to go, whether it's accounting, tax, strategy planning, contingency plan, whatever it is your situation is. I'm sure we can find someone who can help you. So again, Bill, I wanna take it back to you and thank you for the opportunity to share.
Well, actually, we're not done. We still have some time left. So if there's anything you want to elaborate on before we go, and you've made a lot of comments and statements that I think that if you think that there's something that really needs to stand out,
Mhm.
please let's go back and discuss it, and then we can go into Q&A a little later. But we do have some time for you to elaborate on some items. And I'd like to say to my our attendees that if you have any questions, please ask them so that, or put them in the chat, and we'll answer those questions while we're online now. Thank you.
Yeah,
Please
sure.
continue.
Um, so one of the things that I actually didn't touch on that I came across only once with one potential client, this specific client, you know, they weren't really doing, they wanted to reduce their taxes, but they're going about it in the wrong way, that it's kind of borderline to illegal or criminal in a way. So by that I mean they were claiming deductions that they, it's allowed to them to claim if they had actually the documentation to support the deduction. So here's one thing good bookkeepers will always tell you. Before they put anything in the books, they have to see the support for that entry. You would do the same for your business, correct? If you can't book a sales to your company, to your accounting system, if you didn't receive the invoice, if you didn't deliver the service or receive the payment after you provide the service, that's just lying to yourself. So some people, with the pressure of trying to cut their tax bill, they will manufacture deductions, right? They would try to claim certain deduction that easily can trigger the IRS audit. And when the IRS comes over them, they will start asking them for supporting evidence and they don't have it. Guess what happens? You'll pay the taxes and you'll pay the fines on top of that. So I really want to make sure that the information that I'm sharing with you, you wrote them down. And you, if you know to do research, You can go to the IRS website and look to the publications and find the information and spend hours and hours reading and understanding them if you have time. Because you can't leave the financial decision of your life and your family to my hands only. No, you have to be proactive. I always tell my client, double check my work. How will you double check my work if you don't know what I'm doing? Right? You have to be that no one will look out to your business, to your family, to your finance more than you would. I don't leave it to anyone. When it comes to investing in these stocks, I don't just call a broker and tell him whatever they want they can do with my money. No, I take ownership. You have to take ownership of your investment, of your retirement, of your tax planning, of your business. You have to be proactive. We can't leave anything at a chance. So that was the only thing that I really wanted to reiterate. If we have questions, I would be more than glad to answer them.
Absolutely. One of the questions was leasing a vehicle, is that deductible?
Leasing a vehicle, any expense you pay on the interest towards the leasing will be deductible.
Deductible as a business, deductible in personal? How would they deduct that from their taxes?
The bottom line is your any personal expense does not get to be deducted. Let's just make that clear. So when you brought that question, my assumption is it's an eligible business expense. So that's the bottom line. So if you're using, for example, the car 50% personal, 50% business, you only get to deduct 50%, right? You can claim, you know, we are honest people. We don't manufacture information, right? So if you are realistically just using 50% of the car you leased, just claim the 50% of interest.
The simplicity of the question, I'm sure, was reflective of the difference between the two, just knowing personally, can I do this, and business wise, should I do this? So just separating the two, which is what we have to recognize in working as a non-for-profit organization and working as a for-profit organization. What is the best way to approach these how you do your deductions? Because if it's not proper, you can get a response at some point over time. And that actually does bring us into a couple other questions that I had too. What are the tax implications with the legal structure? Your program is about legal structures and tax implications. How can you include, or what is the best way to include your 401k and other benefits that you have to be a part of that tax structure?
That's a great question. So if you are a sole proprietor, the 401k is pretty straightforward, right? Your business, you can create the 401k either under your name, or the business can establish one for you and make contribution. So ideally, you want to have a solo 401k, right? And if you are an S corporation, you can make contribution towards your 401k, and this gets deductible to you, right? In the front of your excuse me, form 1040. But excuse me, the business can't really, any contribution the business makes, if you're an S corporation, is going to be reported as income to you if you own more than 2%. of the S corporation. So that's why it, there is no simple answer to give, but the bottom line is, depending on your legal structure, you can either create a form to reimburse yourself or make matching contribution to your business, or hire, for example, your spouse and give them a retirement account and add the benefits to them, for example, education, for example, some de minimis expense or traveling expense or healthcare benefits. You can give them these benefits if you are, for example, an S corporation uh, or a C corporation. So a number of benefits are deductible to the business, but it really depends on whether or not they can be included in your income, depending on also on whether or not what percentage of ownership you have in the company.
The another, and I can relay this in the form of a statement and a question, because I would like you to respond to it. The two methods of doing business or business engagement, and it's always quantifiable how you want to do business and the development of how you want your structure to be within your business. Um, and I know it sounds somewhat ambiguous what I'm saying, but I'm trying to organize this in a way that we look at business as something that you want to create to be sustainable, long term. There are things that you want to do with your business. We talked about succession planning the other day, and there's so many opportunities having your business that you can engage in that you want to fulfill. The development of a productive business with a sustainable growth and relationship creates capital gains. And this is what you really want your business to be, because you want to create that sustainability for your business. The second way of engaging in business, and these are just some assessments, there are many ways of engaging in business, but just based on some of the comments that you were making, and I would like you to elaborate on, the other way is developing a business that is purposely designed by nature to lose, and be able to engage the business in a way where you do create a minimal capital gain, but at the same time, you can say that it's a losing venture, because you're not really creating capital gains, you're creating a loss. And in that loss, it gives you the opportunity now to, you lost, hence the minimal taxes that you have to pay is based on whatever that loss would be. So there, and clearly right now, in present day circumstances, we're dealing with a situation where maybe people have devised their business to lose so that they can create the tax implications, allowing them to develop a capital gain for themselves and not pay the taxes. So what are your thoughts on developing a business where you should make it a success, as opposed to not make it a success and then have the opportunity to not pay taxes because it wasn't a success?
That's an interesting contribution there. The company that actually comes to my mind is Amazon. In the first 20 years of Amazon existence, it ran on losses. If you go look into the financial statement of Amazon, the annual reports, you'll see every single year Amazon consistently booked huge losses. But throughout that same period, their stock price was doing this, growing exponentially, and their investors were happy with it. They weren't paying dividends. Some people weren't happy with it. They sold the stock and so forth. But to synthesize my answer, I'll say a business doesn't have to generate profit to be successful. So there is a difference between a paper profit or loss, which I really like, businesses that generate paper losses on paper, but put money into your pocket. And really, when you implement a lot of the, even just some of the tax strategies we talked about, you can make your business run on paper, run on loss, which is reported to the IRS, but you will live comfortably because your retirement is taken care of. You have money to pay your bills and so forth. And if you're building good systems in place, right? And your business value will continue to increase. For example, when I advise clients who want to sell business or buy business, we have to do a lot of adjustment on their net income towards what they actually took out of the business as either distribution or cash or benefits. For example, when business owner contribute return to their retirement from their business, get health benefits or employee benefits like cars or certain monthly stipend, for example, parking or transit, all these, we have to put them back to the net income to actually come to the realistic bottom line, the true bottom line. So accounting is interesting. You can always make the numbers look whatever way you want it to look. That's kind of where I would get as a conclusive statement, really. I don't know if that
Well,
answers the question.
yeah, and I appreciate the response on that, because that is the issue that we're dealing with, and that can have a domino effect in a negative way. If in fact businesses, especially unlearned businesses, businesses that don't create a real future, or I mean, the difference between a paper business and the manifestation of an existing real business is the fact that one exists and the other one doesn't. One produces activities, the other one doesn't, and one is self-sustaining and the other one isn't. The decision is what direction that you want to go in, and the end result, though, is that in taking a paper direction that may have some feasibility, may not less necessarily be the sustainable direction, because the backfall on that in how it was done based on paper can have a uh, can be questionable, and you want to steer away from that. So you want to really focus your ideals on developing a business that has real growth potential and real operational potential.
Oh,
And said, please go ahead.
yeah. So just to touch on that, when you're running a business, right, if it doesn't have any value, it doesn't make any sales, and you're just booking losses to get tax benefits, you will get more likely than not audited, and the IRS can make a position that your business is actually a hobby. And hobby, there is limitation. You can only claim deductions up to the amount of revenues you claim with your hobby. So, you know, that's why you're absolutely right. When you are a business, you have to go all the way in. You have to be serious. You have to keep record. You have to act in with integrity and show that you are a business, right? So even just in the simplest form for Uber drivers, you have a records of all the mileages you drive. If you buy any meals during your business, you can claim that as a deduction. If you go to a conference to learn better driving skills or how to talk with client to increase your rating in the app, you can claim that as a deduction, right? You're not in a hobby. But let's say, you know, you like talking to people and you feel like you can start a business but you're not committed, and you set up all these tax planning strategy and you're just booking a lot of losses, I'm not sure. You can always, make your case to the IRS, but I don't know. You're absolutely right, Bill.
Well, what we want to do is make sure, especially when we're talking to existing businesses as well as startup businesses, there is a format that we have to follow. And I like we looked at this more sophisticatedly with the tax applications of going along with our 401ks and developing a structure that works within our business so that we can develop revenues. I think that's real impactful information that you gave out with regard to how money is made, how money is actually developed. And that's not really seen by many in the business environment. And that's what this entire program, this master series is about, so that people can have a deeper understanding as to what it takes to build wealth, generational wealth, and then personal wealth, or personal wealth and then generational wealth. And that's what we've been talking about throughout this entire boot camp. How to develop your business. What is the mindset for developing your business and developing your relationship with others within the business? What is the proper communication? How do we listen better in talking with people and listening to what their needs are and being able to develop from that? How do we engage people and create successions from one business, from one family member to the next, or from one individual to the next? Or do we disband the business? How do we engage the business? So all of these videos that we're doing is going to be available as soon as we get them edited and get them on our SCORE channel so that you can see. But it's very impactful information, and we're real glad to have the Small Business Administration, SCORE, and of course our organization here, which is the SCORE Chicago Black American Council, and of which London Tilla is a member. Within our organizational structure, we're looking to have a deeper relationship with people and deeper relationship with our clients. So we ask that you get in contact with us and let us mentor you, let us work with you, and let us help you build your business. Tomorrow is going to be very interesting. Our
Bill,
program doesn't start until, yes?
sorry, before you jump to the last presentation for tomorrow,
Of
can I
course.
answer just two questions in the chat that I see here?
Sure.
Yeah, so Aureli Lagunas asked, I don't know if Aureli is still there, if you asked about board advisors. So board advisors or board of directors is not only for the nonprofit. Any business, if you are, for example, a limited liability company or an S Corp or a C corporation, you want to have this in place, right? It legal structure, legal structures require these things. If you don't have them, I would encourage you. It doesn't have, you go hire Tim Cook from Apple to sit on your board advisor. It can be your husband, your trusted friend, someone with the expertise you need for your business. Hire them, bring them to be board advisors, and that hopefully can lead on some really tax benefits. I'm just really flying here. There is another question
Yeah,
here
there's quite a few.
from Shiba Abernathy. I did miss my tax. I did my tax with TurboTax. I missed all the deduction. You can file an amended return where you correct all the mistakes. So that's something you can do. Yeah, either do it yourself in TurboTax or hire someone to help you with that. Can I deduct for graphic designer and someone that upload designs to product? I don't know what deduction you want, graphic designer, any independent contractor you hire, graphic designer or attorney, professional, you can deduct it. It's fine. Keep the invoice, write the ideally the invoices exactly what you pay them for at the end of the year, send them 10 form 1099 NEC. You should be great. You should be fine. Renting commercial trucks would be an expense at 100% correct. You are absolutely correct. Just keep good documentation. How do I decide between rent, lease office space, or buying and owning? It's a more elaborate answer than I can give you. I usually do cost benefit analysis for either side and look into the tax implication for either side. So I don't have time to answer that. I'm sorry, but please feel free to reach out in the email or text me on my phone number. Um, so I'm in the process of setting up my startup September 2020. Day one, I'm provide professional service, selling subscription. What advice would you give about setting up LLC versus S Corp? I actually just created a video last night about the difference, some of the items to look for. So if you go to my companies, if you go to YouTube and type Yeto Advisory, on the YouTube channel, you should find a video that talks about that. If you need any further help with that, feel free to schedule an appointment through my website, yetoadvisory.com. Um, can you deduct 3 years of startup expense if you're just launching in 2001? That's a good question. The idea beyond startup is that it's not a substantial period of time, but I could do a little bit more research. Honestly, this is the first time that I've encountered a situation like this. I would need to do a little bit of research to answer that. So if you want to reach out with the question and your email, and then I can follow up. Um, uh,
The object of the characterization of the account
yeah,
as what
well,
would you like to be?
well, the object, which is fine. I can't, contradict what you're saying, but I know accounting is based on a financial assumption that we make. Even if you read the generally accepted accounting principle by FOSB, which is called GAAP, you'll see that they give you options in terms of how you can what accounting treatment you can give to certain accounts or expenses, which also is different to tax treatment of certain economic and financial transaction. So at the end of the day, the financial statement you have on hand are just, records of economic transaction, but biased towards whoever will prepare them. That's what I meant to say. So if you'd like to have a little bit more conversation on that, please reach out. I'd love to talk to you, Ted. Um, okay, when the tax tail wags and
Yeah, I don't think that one applies. And then
okay,
you have Daryl here, thanks with, I believe, I guess this is the email address.
okay,
Yep.
all
Well,
right.
great, great. Well, fantastic. I'm glad we got the questions in too. That helps out a great deal because we definitely want to answer all your questions. Running short on time, tomorrow is our fourth and final day for our master's series. And at 1 o'clock, from 1 o'clock until 2:30, we will be talking with Pamela Rando from JP Morgan Chase Bank, JP Morgan Chase Bank, Andrea Baker at Capital One Bank, and Carl Riley at Fifth Third Bank. These meetings or this dialogue is going to be very insightful. We'll We'll be talking a great deal about banking relations, loans, developing those relations. But moreover, we really are looking for questions. So as we're having our dialogue, we're looking to develop businesses and find ways to get businesses to have better relationships with our financial institutions. What they look for from you as a potential depositor and a loan recipient, to just being a personal banker or developing relationships with a personal banker. So I think these are really important people that you can have some serious conversation with. We will tomorrow, and that's going to be on May 27th, tomorrow, 1 o'clock until 2:30. And Lantadilla, it was a great program we had today. I want to thank you for participating, and looking forward to seeing you more in presenting to the public accounting strategies.
Sounds great. Thank you. I appreciate the opportunity, and thank you again.
Absolutely. Folks, thank you for participating. We look forward to seeing you tomorrow. Bye.
Awesome.